This conference will now be recorded.
Thank you for joining me. My name is Steve Tuttle, and I'm the Chief Investment Strategist at Signet Financial Management. I'm also a partner. Today, we are going to discuss what to expect as the year winds down in our fourth quarter outlook. I'll start with a quick review of the market forces that are impacting client portfolios. There's a few main drivers. There's a few main things that are top of mind for most investors this year. On the positive side, the Fed policy is stimulative and it's accommodating. The Fed is cutting rates, and this is also occurring across the globe. That's a very positive thing for equity investors. On the negative side, the major driver is trade tensions between U.S. and China. So the key question looking forward, at least in the near term, is can these central banks and the U.S. Federal Reserve specifically, can they reaccelerate the global growth despite the trade tensions? There's also some other positive influences that I'll note. Corporate earnings have been very positive, and they continue in the third quarter announcements. Interest rates are low, and the U.S. consumer is very strong, which is providing a positive boost to the U.S. economy. On the negative side, politics, particularly in the U.S., but it's really across the globe. The U.S. has a big presidential election coming up next year, and there's a lot of uncertainty that goes along with that. The global economy is also slowing somewhat. In the U.S., we're still positive, but even in the U.S., we're slowing a little bit. And then sentiment. There's a lot of negative sentiment out there that does have an impact in terms of investors' willingness to take to accept risk. If you look at recent returns, they've been very positive this year. 2019 has been a wonderful year for investors. It's a good year for asset allocation strategies, as both stocks and bonds have performed fairly well this year. And that may be a little bit of a surprise given the negative sentiment that I just referenced. On the U.S. stock side, large is doing better than small. Value and growth are actually fairly even year to date. Recently, value has been outperforming growth, and earlier in the year, growth was outperforming. U.S. is outperforming foreign markets. That trend has been going on for a while, and it continues, although in October, we've seen some foreign markets perk up and actually outperform on the U.S. side, so that's something to note. On the bond side, credit markets have definitely rewarded investors this year. So corporate bonds, high-yield corporate bonds, high-yield muni bonds, they've done very well. Even foreign emerging market bonds have done very well. Also on the bond side, it's been a good year for owning long bonds and for accepting duration. The long U.S. Treasury bond market has been very robust this year, and returns have been solid. If we look out across the investment universe, we like to look at the economic cycle. We like to try to look at data and hope it gives us some insight into where we are in the economic cycle. Essentially, there has been a recurring pattern fairly regularly of the U.S. economy going through a period of growth, and then that growth stabilizes. Eventually, the growth slows, then it weakens, and then it recovers back, and the economic cycle begins again. So while this is not a prediction tool, it is useful in terms of how we position portfolios. And what we're seeing right now is that we're in a late stage or a late phase of the economic cycle. And what this means is that it may be harder for investors to generate returns that you need. And the next 5 years, 10 years may be a little bit more difficult to generate return and yield than the last 5 or 10 years. That doesn't mean the situation is entirely hopeless or bleak, but it does mean that investors may need to reset expectations and take a different look at their portfolios. The good news is that that's what we do here at Signet. We design portfolios for the full market cycle, for the good times and the bad times. And we are very confident in our ability to navigate full market cycles and to make adjustments that work for our clients. In terms of our positioning looking forward on the stock side, we're pretty comfortable with owning stocks. We think there's still upside potential for equity markets. In terms of our preferences, we still like U.S. stocks over foreign stocks. And in terms of factor exposure, stocks that exhibit growth at a reasonable price, and particularly the quality factor and profitability, those are areas that we want to focus on in this market. And so by that we mean stocks that exhibit lower debt, consistent earnings growth, and profitability. We believe that these characteristics should be beneficial to investors, particularly in times of uncertainty and late in the business cycle. On the bond side, it's been a very good year for bond markets. I don't expect to see the same magnitude of return in the bond markets going forward. However, we do think it pays to continue owning some duration, to continue owning some longer bonds, specifically because this can help. It's a very effective tool for offsetting equity risk, for managing downside. So the trick is on the bond side to balance the need for yield versus safety. And for that, we like a barbell approach where we own, and you'll see it in your portfolios, we own some very short-term instruments, CDs, treasury bills, short corporates, and munis, and we're offsetting that with some longer duration bonds that give us more exposure to duration and some credit risk. There's a few charts I'm going to highlight here. I think they're particularly relevant for explaining our positioning. First, let's look at valuations. Valuations are not stretched right now. And valuations are important because historically they have an influence on long-term returns. If valuations are low, long-term returns tend to be a little higher for the broad markets. If valuations are high, long-term returns tend to moderate or be a little bit lower. If you look at where we are right now, even though we're 11 years into a bull market, we're not at excessive levels. In fact, we're right around the 25-year average in terms of the S&P 500's forward PE ratio. To this, I'm very encouraged. I think it means we're not at excessive levels, and I think it means that there's nice return potential out there for investors. This chart is for technical analysts out there. It's not something we speak about often, but I think it's interesting to look at what's going on in the value index. This is a chart of the S&P 500 value index. It goes back a few years, and what you've seen going back to the beginning of 2018, that the value index has basically been in a trading range. It's gone up, it's gone down, but most recently, value is starting to perk up. It started to outperform growth. It started to outperform the broader markets. And in fact, it's now just crossing above this long trading range that it's been in. And to us, that's a very encouraging sign. I think the value index does offer some opportunities for long-term investors, and it's something that we will continue to watch closely, that's for sure. On the bond side, we like to look at credit spreads. There's some very useful information to be gathered by looking at the amount of yield that you receive for taking on credit risk, like a corporate bond, compared to owning a treasury bond, which has no credit risk. And what you'll see in this chart is during periods of distress, when the stock market is struggling, like in 2016, 2012, if you extended this chart back, you'd see it in 2008, in 2000. In each of these periods of time, stock market is struggling and credit spreads are spiking. What you'll see today is that credit spreads are relatively low. They're certainly not high. And to me, this chart is important because it indicates that the bond market is not signaling a recession is imminent. it could agree with a slowdown scenario, but it certainly doesn't indicate that recession is imminent, and that's a good sign. The rate of change in interest rates and what the U.S. Federal Reserve is doing with interest rates is an important factor. It has an impact directly on bond markets. It also has an impact on stock markets because it has to do with how easy is it to borrow money and what's the expense to corporations to borrow money. Going into 2019, the Federal Reserve was raising rates, and that was expected to continue. But what we saw this year, somewhat unexpectedly, is a reversal of policy. The Fed is now cutting rates, and the expectations looking forward, and that's the brown line on the bottom, the expectations are for rates to continue dropping, for the Federal Reserve to continue pushing short rates lower. And that's a positive signal for risky investments like stocks. So I'll end with some key takeaways that I think are important. One, we think it's a good thing to be positioned for upside potential in stocks. We do see more upside in stocks. If you're investing for retirement, if you're saving for retirement, if you need growth, stocks, U.S. stocks in particular, are still attractive and there's still upside potential. However, the amount of return you should expect might be a little lower looking out the next 5 years compared to the last 5 years. So prepare yourself for lower returns, make some adjustments. And it may be a good time to play defense. Coming after some strong returns this year and the last 5 years, 10 years, you may be sitting on a lot of gains. You may be sitting on more risk in your portfolio than you need to accept. So take a look at your overall allocation, and perhaps it's time to play a little bit of defense. And that could mean simply shifting the factor exposure in your portfolio, tilting a little bit more towards stocks with quality, with profitability, trading at a reasonable price. It could also mean adding to the bond exposure in your portfolio, even adding to longer duration exposure in your bond portfolio. With the Fed cutting rates, there may not be as much risk by accepting some longer duration bonds as there were the past few years. And long duration bonds have proven to be pretty effective for helping stabilize portfolios and offsetting equity risk. Which brings me to my third point about bolstering downside protection. It's okay to be a little bit more defensive in fixed income, I think, looking forward. That means reducing credit risk modestly, a slightly higher allocation to cash and longer duration, sort of a barbell approach, I think is a good place to be looking forward. Finally, I'll end with the idea that diversification remains the only free lunch in investing. You need to have exposure to multiple sources of return. There's too much uncertainty out there. It's too difficult to tell exactly how markets are going to behave looking forward in the next few months, quarters, years. So be diversified. Have a portfolio that balances yield and safety, that balances growth prospects with stability. And we think here at Signet we do a very good job of that, about helping clients find that right and that balance that's right for you, and then maintaining it and helping you stay on your path to achieving your goals, and to do it with discipline, to do it with patience. So on the call now, thank you for spending some time with us. If you have any questions or need to speak with me, Steve Tuttle, I'm always available to speak, but you can also speak with your advisor at any time. Thank you and have a good day.